Welcome everyone to day 3 of MOA's Virtual Organic University. This morning we have Jeff Schahczenski, who's with the National Center for Appropriate Technology, NCAT, in Butte. And he does a lot of work on the economics of farming, including crop insurance. And then later today we'll have accessing federal programs as well. So I will just let Jeff take it away.
Well, good morning, folks. Nice to be here this morning. Yes, Jamie's right. I think I might be on the verge of insanity because I've calculated now 16 years studying crop insurance. Paid some bills, so I guess it's worth it, but it's always a topic that never everyone gets too excited about because it's just boring insurance, right? And so I'm going to advance this. So I'll use jargon. There's a lot of jargon in insurance generally, and crop insurance in particular. And sometimes, so if I'm going through and you folks, if I start using words that like, what the hell is he talking about? But here's some of the basic terms: liability. I mean, these are generally known, but just to be the value of what is insured. Indemnity is the payout. Supposedly when you make a claim, you'll eventually get a payout, and that's called an indemnity. And then a premium, which gives you all this, what you pay for it. That's what's going in. And in the case of crop insurance, it's both the farmer and the taxpayer pays part of the premium. And again, let me know when I'm using any weird jargon. So the basic question is, do farmers need crop insurance? It's been available since the 1930s, since FDR and the great programs that came out of that are very related to the agriculture and the farm bill. And do organic farmers in particular. I'm not going to talk about ranching, although there are livestock products, and one of the products I'll talk about encapsulates livestock. Livestock has never been served as well with insurance as has cropping systems. Do they need insurance? Well, this is as of 11/2, could have got a newer one, but this was the indemnities paid out, the payouts, the claims paid out to date for the 2020 crop year. And the darker the thing, the more payout there was. So when you look at these indemnity maps, you can see where things went bad for various reasons. There's a lot of causes of loss, but they're all summed together here. So the really dark red is already over 10 million plus in indemnities, and you'll notice there are counties here. These are all the 3,000 some counties in the United States. The unit of analysis in crop insurance is the county. One county can have a crop policy and another county might not. So literally within the same state that happens, and I'll show a little bit of that later. But you can see there's places where there weren't any indemnities paid, but usually those are like mountains or places where crops that don't have much insurance are. But you can see, a sense where some of the, at least last year, where some of the riskier places, at least where there were causes of loss last year. Here's a really cool tool, and that's why I came in today, because we have better internet here. This was made by the Climate Hub, and I find it really fascinating, because I find crop insurance fascinating. But they took all the crop insurance policies and they put this data, which is readily available. Again, that's a county that I'm going to shift to state to make it a little clearer. Again, this is from all of the insurance policies from 1989 to 2018. So again, in case the darker blue, again, so over that period of time, there's somewhere in the dark blue, there's somewhere between 10 billion and 17.8 billion dollars worth of indemnities paid out. And in a way, if you look at this, you can start to think, these are the really risky places to grow crops, is the darker places. And Texas has a kind of sordid history in crop insurance as being, one almost thinks they oughtn't allow people to insure crops in Texas because they have so many claims. And it seems North Dakota is right up there. But these are the places where over time, over that long period of time, a lot of indemnities have been paid out. And Montana is not exactly the lighter colored one either. So it's kind of risky. The other interesting thing with this cool map is you can pick a specific state, and now my thing is in the way, so I have to go here, okay. And I can look at Montana specifically over this period. So we've spent for a long period, $2 billion, $2.4 billion in indemnities have been paid out. You can see how the indemnities have been paid out over a year. You can see what crops received the most.
Hey, Jeff?
Yeah?
Are you showing us a screen because it's not showing up? We have the ag risk viewer.
Oh, shoot. You don't see the aspect? You seen the
No,
aspect?
we just see the screen that says ag risk viewer with the link.
Why isn't it showing it then? Oh, I guess it's a new share. Okay, I see this. Maybe. Oh, there we go. Can you see it now?
Yeah, there you go. Thank you.
Okay. And can you see my thing moving? Just to have the right screen?
Yes.
Okay, so I clicked on Montana. So this is the United States. These are all the indemnities over since 1980 something. And again, you can see the states like Texas and North Dakota are darker, and then Montana's kind of dark. Over that period, $2.4 billion. You can see the indemnities paid out in different years. So, you know, these are the particular, when the indemnities are hard, you can see those are the particularly bad years where, and you can see where things went wrong. You can see here the different crops. So wheat, you know, we grow a lot of wheat. So obviously over that period of time, a lot of payouts on wheat, barley, peas, forage, and even rangeland is getting it in there. Down here, you can kind of see causes of loss, which I think are kind of cool. You can see that drought by far is the biggest cause of loss. Hail, and people often just buy hail insurance, which interestingly is not a public subsidized product. Hail insurance was one of the first crop insurance policies in the country, and it was done all privately. And I guess it was because they could figure out how to set premiums right, and they could actually do that under private insurance. Excess, so too much heat, exactly how heat and drought. Area plan has to do with a certain type of insurance.
Jeff, we have a question.
Yeah, already. Okay, cool.
And it's from Mark, and it's, what is insured, the per acre expense for the crop or the expectations?
What is insured generally is either yield or revenue. Most policies, and I'll get to this later, most policies to date are for the most of the major commodity crops, not for the horticultural fruit and vegetables and all those so much. That's a whole different kind of segment. But for the major commodity crops, most people are buying, like 89% of folks are buying revenue, which protects both price and yield losses. So when I'm showing you these causes of loss, they are encapsulated in revenue because obviously a drought will affect yield, which will lead to an indemnity. But you'll also see this way down here, this decline in price. So actually sometimes between when you plant and when you harvest, there is a decline in price, and that is covered under revenue in policies, even though this, as over time, this has not been a huge cause of loss to the degree there's volatility in the markets and you have revenue insurance, which is more and more the case currently. That wasn't true back in 1980s, but anyway, so it covers both risks. I was going to get to that later. I was just showing you some of this data right away. I should probably get out of here, but now I got to figure out. I'm going to close this, and I'm going to have to do share. I'm going to go back to here. And do you see it again? Am I back? Am I doing it right?
You're back with your ag risk viewer link. Yeah.
Okay. So this will answer Mark's questions maybe in a little more detail. This is 2019 data. Generally, there are really two types. There's yield insurances. There's really a lot of different types of insurance, but they come down fundamentally to protecting yield, and they're yield related, which means when they're yield related, that's usually a multiple peril or a cause of loss that's due to like weather, drought, heat, all those kind of what people typically think is the reason why one would buy insurance. The other side, though, is revenue protection, which adds in price volatility, because a risk that all farmers and ranchers are exposed to is the volatility of the market. You know, when you plant, it's $4 a bushel for corn, and it could be $3.50 by the time you harvest, and that's a risk you take. You don't know what the price will be in the future. So we created this. The government created this product called revenue insurance, which protects against both causes of loss. There's really a third cause of loss, which would be your prices of your inputs could change fundamentally over time. But so far, no one has come up with a added input insurance, although people have discussed it. The point being is that this is in billions of dollars, and this isn't national. So major yield policies have $21 billion in liability, the value of what's covered, and about $1 billion in subsidies. But you can see that most policies now are revenue-based, or more of them. So $80 billion and $5 billion in total. So you can see between the two, the currently in 2019, much more, most folks are taking out revenue insurance to protect against that future loss. To get an organic perspective, I should have updated the 2019, but this is pretty much the same from last year. So if you just look at organic crops per se, again, you'll see that 52% is organic revenue and 41% is yield. Now, interesting, if you look at non-organic, take out the organic, you've got basically 69% revenue and only 12%. Now, the reason that's true, and whole farm revenue I'll talk about later, which is a very small part of the total crop insurance program. But what's interesting to see about that is if you look at the organic sector, there's far more yield insurance coverage than there is in the non-organic sector. And the reason for that is that when you get to non-commodity crops, the major corn, soybean, wheat, then the only policies generally available for organic growers are only yield policies. And also the dominance of in the non-organic world, the dominance in just the sheer volume of commodity policies being bought that are revenue kind of overwhelm the statistics. But historically speaking, organic was kind of only in the early 2000s was it actually even separated out as a different venue for crop insurance. And so basically the policies have been made to serve large non-organic with revenue policies. And it's only in kind of organic is paying a kind of a catch up. Although I would say from our research that we've done recently in the last 5 years, organic commodity crops are being serviced probably far better than they ever have in my lifetime with good revenue policies now. And I'll show you a little bit about that. So what are the options? Individual commodity-based revenue or yield. That's the typical way the non-organic world works. And that's kind of for those that grow those crops, that's how the organic works. There are also these, but I'm not going to recover those. There's some livestock products. And then I will cover and spend more time on whole farm revenue, which I've spent too much of my life studying and understanding, but it's a very different concept. That's another option. And some farmers in Montana, organic farmers, are using whole farm revenue. Again, what's available by county? I'm just going to do a quick, I won't spend too much time with these things because I guess I have to keep sharing them. But I think this is really cool. This is a tool that's available, and I'm going to share it coming up here. Okay, you got it? You see a map of the United States with all the counties?
Yes.
Okay. So this is a really cool tool. This is on the RMA website. It's called the Map Viewer. And it doesn't have all the products in it and all the products, but let's just pick the 2019 because 2020 is still going. And then it has all the commodities that you want to. So you say, oh, can I get blueberry insurance in Montana? Well, you go to this map and you hit blueberries and you wait. Oh, they're going to ask me irrigated. I'm going to say non-irrigated because we don't know. Well, maybe we had non-irrigated blueberries in Montana. I don't know. But look at that. See those little green things? Those are the only counties in the whole United States where you can buy non-irrigated blueberry insurance. And in a way, this actually tells you where are most of the commercial blueberries grown in the United States? Well, where there's insurance available. But poor old Montana, you know, you can't grow a blueberry here and get it insured. That's the bottom line there. Now let's take another famous crop, which always drives me crazy. Oh, I'm not in the wrong place, but I did something wrong. I was supposed to do that. I'm supposed to go to commodity programs. That's a supplemental program. I was in the wrong link. Okay, back to 2020. Select a commodity. I'm going too fast. Now let's do another one called that is a very popular crop that everyone grows, corn. And I got to wait a few minutes while it churns out the map, but it's coming. I think it's going to come pretty quick here. It takes a little bit of time. That's why I didn't want to spend too much time on this, but I love this map because it's so cool to show you. Come on, come on. I know it's going to come. I did it earlier. Oh, okay. Here it comes. It just takes so long because now look at that. Those are all the counties where you can get corn insurance. What amazes me is you look at Montana. Now, one can argue about this or not, but sometimes I feel like, should we be growing corn in Montana? Is it too risky to grow corn in Montana? And why are we federally subsidizing corn insurance in Montana, but almost half the state has it available? And if you go back to that other one, indemnities, I bet there's a lot of indemnities paying on that corn, which makes you feel like, that may be the best place in the world. But corn is so prolific. And now I'll tell you this is the product that is the least insured as an individual insurance policy in the United States. And I'm amazed that it's even on this list. I don't even know what clary sage is, but watch this one. There you go. 3 counties in North Carolina. It's the only place you can. Now, how? There must be a really good interest group that, argued for crop insurance for clary sage. So this must be the clary sage growing capital of the United States. Well, enough of that. So let's go back. Shut that off. I'm going to skip oops. Got to share my screen again. I'm going to go back to the thing. I'm not going to spend more time on this unless people want me to. I can do it later. I'm bringing it back up. You got it again? There's also this thing called an actuarial information browser that will tell you down to the county what specific crops are available in that count that are insurable within that county. It will also give you what's called T yields or county average yield data. It's kind of interesting just to see specific counties. And again, from county to county, things can change. So it's kind of interesting. Now I'm going to talk about why one might look at whole farm revenue. The first reason one would look at whole farm revenue is you can realize in Montana, if you grow tomatoes or any vegetables, there's no individual policies available in any of the counties. Basically, you're out of luck. Well, in the years that we worked on whole farm, 16 years now that we've been working on whole farm, one of the things that we eventually got changed was this policy is the only crop insurance policy available in every single county, including Hawaii and Alaska, in the United States. So what does that mean? That change means now that you can grow tomatoes in Montana, insure them under a whole farm revenue insurance. That is a big, significant change. It only took 16 years to get it to do, but you can now do that. And that is something that no other crop insurance policy is available. There's no other, even corn, as you saw, wasn't available in every single county in the United States. So that was an achievement that I was part of in my life. His major purpose is to ensure, and this is far was to stay in business. That's again, why would you want that? is farmer decides. So in other words, what also is interesting about whole farm is it's not specific to a specific crop. What it does is it ensures, based on the history of the farm, the revenue of the farm rather than any specific crop. So the farmer can grow whatever they want, and based on their historical generation of revenue from that farm, they can protect a certain percentage of their revenue. And this is completely different than any other type of insurance or crop insurance. The farmer decides, again, what to grow and what to protect, not the policy per se. Again, almost any product in the United States, actually any product really, well, there's some things like show dogs and things like that, but basically it'll cover anything. You can even say like other crop and it will be insured. Incentivizes crop and livestock diversity. It also covers livestock because it doesn't care if you're generating income from the livestock or you're generating income from the commodity or the farm product. So it covers both of those encapsulated in the revenue of the farm. And it also incentivizes diversity, which I'll show you later, meaning the more diverse the farm, the lower the premium, which makes sense because you have diversified your farm, so you've lowered the overall risk of losing revenue over time. And it's spread across all products grown, and it's kind of a package deal. Rather than buying individual policies for all your different little crops, which that adds up to being a lot more money, then you get a lower price premium because you're buying kind of a package deal. This data is not available generally. This was from a research program, an ORE grant. I actually got data from all the country, from whole farm throughout the country. So I wanted to look at it in Montana. That's why it's old data. It's 2017. But it is interesting to see the people that used, these are people that used whole farm revenue in 2017. $41 million worth of wheat was, non-organic wheat was actually insured. This is the expected value of the farm. So it's not, even though I'm saying wheat was one of several products that represented it, but this is like stripping out the different things that were in that whole farm revenue. So you can see that, you know, typical crops, you can see that there's somewhat some things. You can see alfalfa and cattle, some things that weren't necessarily have individual. You can also see overall that non-organic farmers used whole farm more than organic ones did in 2017. There are, however, with every good thing, there's always limitations. First, you have to be, if you're not a beginning farmer, i.e. you have been farming you've been farming more than 10 years, you have to be in your 6th year well, basically you have to have 6 years of historic records to be eligible. And if you're a beginning farmer, you only have to have 4 years of farming behind you. So you can't, you know, if you're a very beginning farmer in your 2nd or 3rd year, you can't access whole farm revenue. You have to develop a revenue history. There are some restrictions on the amount if you can cover it. And it really, and this is a killer, to fill out the paperwork and forms, you really do need good record keeping to access this program well. The coverage levels are quite high. Interestingly, if you have 3 or more commodities, that includes livestock products, you can get the 85% coverage. That means you get 85% of your historic, it'll come clearer later, but of your revenue. But anyway, it's a fairly high level of coverage. That's the highest that even an individual policy can get. But you have to have at least 3 to do that on your whole farm. Interestingly, to get a 75% coverage, even this is kind of crazy for whole farm, you only have to grow 1 product and you can still get 75% coverage. And there's a maximum amount of revenue that can be approved to cover. That's what that number in the last column. But this one cannot be a product that is not insurable some other way. So in other words, if I'm only growing wheat, I can't buy whole farm revenue wheat policy because there is an option. But if I live in a place where there isn't an option and I'm growing only 1 and I only want 75% coverage, I can actually buy whole farm even with 1 product. I don't think that's very usual, but it does happen. Hemp is now available. You can use whole farm. Hemp can be one of the crops of your whole farm's generating income that can be insured from all the flower seeds and other things. However, it does not cover the major cause of loss, which is that the THC level is too high. That is not an insurable cause of loss, and that unfortunately tends to be, in other words, if a crop gets hot, if hemp gets hot, meaning it gets too high THC level, then basically you have to destroy it, and because it's illegal. Although I guess it's going to change in Montana pretty soon here, which will be interesting, a wrinkle on that. And there's a new direct marketing option under whole farm that just came available this year, and I'll explain that briefly. Again, the practical limitations requires really to provide yield and revenue data from all the crops and livestock products you grow. And people don't necessarily keep that level of detailed records. Some farms may need to start collecting this data because they don't have to be able to access it. If you grow on contract, that's actually a lot easier because that establishes a revenue a lot easier. So to the degree you do contracting, it's a little easier. Can sometimes be selling wholesale can be. Anyway, if you derive the majority of their income from 3 to 7 crops, it gets, if you have 30 different crops, you're highly diverse, smaller farm, do you really keep records on all 30 distinct things? And there's some wiggle room around that now, but it still becomes onerous. The more things you have to keep track of, the more difficult paperwork. I'll do a real quick example here. First of all, find an agent. The agents will quote you the premiums. There are only 13 crop insurance companies in the country that sell federal products. There's some that sell private, but many of them sell both. They essentially service the policies for the federal government. The government sets the rules. The companies share. They basically get a fee for providing that service, as well as they share in what's called the underwriting gains. So if they can basically make some profit by, by the fact that they didn't have to pay out more indemnities than they took in. So they get a little, basically it's a pretty sweet deal. They get pretty much a guaranteed rate of return being a crop insurance agent. But for that, they have to service you and find an agent that's going to run a whole farm revenue for you or any policy. Don't put up with a crop insurance agent who's giving you runarounds. Basically, they need to do these. They're obligated to do these. They're obligated to sell these federal programs if they're one of these 13 companies. So you could demand service from them, and you might as well work with somebody who wants to help you other than something. But we found we found people that, for instance, with Whole Farm, they really try not to sell it for a lot of reasons, mostly because they don't know it, and it takes a little longer to write up a policy, and they don't like to do that. You're going to have tax forms, and all of these things are going. And this organic system plan can help because a lot of the data that's necessary for Whole Farm is in there. This is just an example. These may be different for your farm. You cannot easily, with a whole farm revenue policy, it really depends on your revenue history, your specific set of crops and livestock products. And so you really do have to run it individually. So this is just a made up example. So basically.
Jeff, Mark has a question. Sure. Can you combine types of crops into categories like brassicas instead of tracing cabbage and mustard, etc.?
Unfortunately, no. They want them split out even within those groups, which has caused consternation. Now, there is something coming up I'll show you that kind of helps, but it doesn't kind of help. And I'll get to that later. But it's been a pet peeve, and as this has gone on, and every year I've been part of a group that literally goes to the guy who runs Whole Farm Revenue, and we make recommendations and improve it. Some years they've taken our recommendations, some years they blow us off. This last year they basically blew us off. We know, we have research data, we know how to improve it, but that doesn't mean you have the political will to do it, even though we have very good reasons and all of that. So there are things that are wrong with this that they could fix, but they don't listen to us, at least yet. Maybe it'll change with change in administration, who knows. But anyway, it's been a pet peeve of mine to make it easier. It used to be simpler. In the early days, it was a different kind of product and it was much simpler. And all the federal government has done is made it more complex over time, and I think unnecessarily so, but that's my opinion. So you basically what you do is you get it in what they call an historic approved average revenue from the last for 5 years of history, or 3 if you're beginning, and what is approved is a kind of a negotiation. You have to go through all your records, basically your income tax records. Your Schedule F is the general standard way. They can convert other forms of Schedule Fs into other. So if you have like a C corporation, LLC, those can be converted back into the equivalent of a Schedule F, and they can figure it out depending on the tax records. But the way you document your historic revenue is by your tax records, and Schedule F is typical. And this is need to be done by your agent, and make sure they have to make sure there's certain things that have to be pulled out, like distribution from a cooperative, some little hairy things that you're just getting down to what was the actual revenue generated by those raw crops and products. You also have to take out things like, if you take apples and make them into applesauce, you can't insure the applesauce, but you can insure the apples that went into the applesauce. So again, what is the revenue of the apples that go into the applesauce? That causes consternation too. So if you're a value-added producer, that can also add to the complication of doing the policy write-up. So just a simple example of a farm, Dryland Hill County. These are actually from some real data, more or less. So you see this farmer had a rather interesting history of revenue, and their average is 358,000. So some years the farm was as high as 500,000, 600,000, but some years their revenue wasn't too good. Again, your farm or ranch or whatever is going to be different, and the volatility of your revenue can make that average be very different. So it's hard to say how a whole farm will work for you without looking at your very specific revenue history. This is a 3,500 acre dryland farm. T yields are just the count. I just use T yields because those are average county yields. This again, organic average yields, which are more or less based on historical, to the extent there is organic farms in that county. Otherwise, they kind of make it up. But anyway, these are just, that's where the data comes from, and the projected price. So in the expected year of insurance, you remember we had 358,000, their average, but in this year of insurance, he thinks they're going to produce almost $417,000, which is not unheard of. It's not unrealistic. There were years when they produced $600,000 in gross revenue. So it's not unrealistic. But so this is basically that. So here's the really important point with whole farm revenue. So you have this historic approved of 358,000. You expect to get 417,000, and the insurance, the basis of your insurance guarantee is the lower of those two numbers. So in other words, if you take an 85% coverage level, you're only going to be able to cover 85% of 358,000. Now you say, but the farmer says, but look, I'm going to really make 417,000. I'm going to be underinsured. I mean, I want to cover all 417,000. And the agent and RMA will say, well, yeah, but we looked at your history. Your history is, it's kind of all over the board. And, the real possibility of generation is more like the average than it is in any given 1 year. Take it or leave it. You got to take that. The rule is the lower of the two. So here's where the farmer has to start to decide. I mean, first of all, they're only going to get 85% coverage, which means they can have a 15% loss without seeing a dime. And it's also going to be based on their historic average rather than what they expect. So a farmer might start to think, I'm underinsured. I don't know if this is worth it. But that's what you have to decide. Now it gets really complicated because we did this group. I mean, me, a bunch of us changed it. We said, well, gee, that's terrible that it's based on that average revenue, because what if a farmer has really crazy volatile averages, but really, he's getting better, and so that his revenue is going up. So they have they do have already built in a kind of I would call it like an expansion factor, but like if you're trending upward in revenue, it'll actually give you a little bit higher approved revenue, historic revenue, not your actual average. It'll give you a little bit of a bump up because you're improving. Well, we said, well, we need more than that. We need this to be, you know, take out the volatility of revenue a little bit so that the farmers' expected revenue and historic revenue be closer together. That way they'll feel more insured. So they came up with, we suggested this, and then they came up with this crazy way they did it. So now you have to run this 3 times. You can do it the standard way, historically. You can do an exclusion of a bad year, meaning like say you had a 0 revenue year, you can take that one out completely out, and then again raise your average. So you're again closer to your expected. That takes some volatility out. You can do a 60% substitution, meaning you basically take any year that's below 60% of your average can become that average, which again will take out the volatility of your revenue, which makes it closer. And you can use, if you have used whole farm, you can do 90% of your historic previous one. So that gets more, so basically, now this is why agents don't like to sell it. They have to run 3 different scenarios on your history and see which one is best. And I did this for this example, and I showed you that in this case, excluding 1 bad year gave you the best level of liability coverage at the 85% level. It also basically the premium, so the premium was 34,000 on a 354,000. I'm just getting you the net less the premium. So this is if we had a 50% loss, what would it be the payout? And really basically, you know, you're getting about $34,000. So again, you know, all of those things factored in, you know, you have to look at this and say, is that $34,000 premium worth the coverage? In this case, it would have been pretty good. The other alternative would be to buy individual policies if available for those same crops. And that's what I did here. So if you just bought wheat, barley, spring lentils, there's no insurance for that, so you couldn't even cover your hemp. Safflower only has yield, so you wouldn't get any protection from price. But basically, if you bought these as individual policies, that would cost you $57,000 in premium. So again, here you get the package deal. You get $34,000 to cover the whole package. Now, be careful. If any one of these crops does better than expected, then your whole farm's revenue may not change that much. However, if you bought individual policies and one of those things either lost revenue or yield, you might get coverage. So it's kind of a game, you know. What farmers can do, and this is possible because you can buy both individual policy and a whole farm coverage. Some people will have very valuable crops that say they have a special kind of wheat and it is insurable individually with a revenue policy. They will buy that individual revenue policy for that one crop and then put a blanket whole farm revenue coverage over the whole farm. So you can mix and match too. So there's all kinds of scenarios you can play with this. I also wanted to show you that the impact of diversity. So the diversity lowers whole farm premium costs. If we move from 5 to 3 products in this example, then we see that the premium actually goes up from what it would have been compared to that, not by much. So diversity lowers the premium cost by 4%. Is that an incentive? I actually think they should make that incentive higher, but it is what it is.
Do we want to pause and see if anyone has any questions? Any questions, everyone? Feel free to either use your mic or in the chat box. And I think, okay.
And here's Mark's example in the new wrinkle that just came, that is only available for the, first of all, those different scenarios with the 60% and 0, that was only available last year. And that was due because the year before we argued for it and they actually listened to us. So last year, you had that available where you could do those different things with your historic revenue. This year, they added one more thing that we didn't even ask for, but they thought this would be helpful. And no one knows this is helpful because it's only available for this first year. But they basically, let's just say that this was a vegetable producer And the gross revenue is expected in 20 is 40,000. It's 10,000 from potatoes, 10,000 from Dixon melons. Anyway, and then all the other commodities that they grow are direct marketed. So this year they've distinguished a direct marketer from a non-direct marketer. And to the extent your products has historically been based on direct marketing, you can literally lump all those direct marketed products into one big category, kind of like where Mark was going when he was trying to lump together all of the same like brassicas all together. Problem is no one really knows how this is going to work because one, have you always been a direct marketer? Two, do you direct market at 100% of all the things you grow? Not likely, but at least to the extent that you direct market some and you have good records to show which ones have been direct marketed versus one not direct market. And what they define direct marketing is literally to the consumer. So if you market it to a restaurant, that's not a direct market. Wholesale, obviously it's not. But this is there to supposedly make it easier for people who have, you know, they have 40 different things and they sell 80% of them to a farmer's market. Well, if that's true and they have a history of that and they want to do it, then they can just lump those all together, and certainly that will make it potentially easier for those folks. However, there's this kind of wrinkle in there, and they say, well, but you know, even if you do that, we still want some records to show that you really direct marketed and which ones you really direct marketed, and that could be hard for somebody with a very complex thing. So I'm not sure this is going to be an aid. They put it in this year, but you know, it's kind of interesting to see. Down here, you can see a premium for this policy would have been $1,633 and the revenue guarantee. So it's not exorbitant policy to cover, and something I think that the horticulture vegetable producers basically comes down to, is it worth the time to collect all this data? And again, when you get done with it, you want your agent to run all the scenarios for you and you see what the premium cost is. And you have to decide. I mean, it's just like all kind of insurance, you know, you want to take the risk or not. And there always are alternative ways to protect risk in terms of the way you farm to lower risk. Risk is not only price and yield related. There are other ways to protect against yield variability. I mean, some people say the diversity of a farm itself is its risk protection. And I would argue probably ones that are direct marketing with 30 different crops, I would argue their revenue isn't as volatile as someone who has only 3 or 4 crops. And therefore, they may not need insurance and they may not want to go through all this bother. And I think that's just fine.
Mark has a question. The question is, so we keep records or management, taxes, organic farm plan, and now for insurance purposes?
Those records are needed to obtain a whole farm revenue. Well, all insurance, you'll have to have records to establish your historic yields. And for whole farm, it's a little bit more complicated because I didn't go into it, but they also want a record of your expenses. So a whole side thing I don't want to get into, but it's the only crop insurance where they actually historically document your expenses as well as your income, because I guess they think there's fraud in. So if you do not spend 70% of your historic average expenses, you can get penalized and lose some indemnity, some payback. It's the only, we asked 4 years in a row to eliminate that. There's no reason for it. No other crop insurance policy requires that. But for some reason, they do it with whole farm. That's another wrinkle. But I guess what Mark's getting at is, yes, you need pretty significant record keeping to substantiate both. I mean, you have your tax records, but they put this little proviso in the rules saying that if the insurance agents suspect that your tax records don't reflect your real historic revenue, they can actually ask you to substantiate your tax records with additional records. Now, it's technically they can, and if they want to be onerous, they could and do, and that often drives people, particularly with a lot of different crops, away from this product because they just don't want to. And I really don't think they should have that wiggle room in there. But these things are set up, like all insurance, to the benefit of the insurance companies, and in this case, even the government in a way, and not necessarily the producer.
So Mark has an additional question about substantiation.
Yeah.
Will extrapolation or other guesswork do, say on an affidavit?
No, it's not so much an affidavit. It's just sales records, basic sale records that show that your revenue reported on your tax form is accurate. I mean, if in a way you kind of have this like idea of tax fraud versus insurance fraud potentially going on here, and so they're fearful of insurance fraud, but I don't see why any farmer would directly want to be fraudulent about their tax records are their tax records. But obviously, if they are investigated for tax fraud, they would have to substantiate their taxes too. And then when you go on to the next thing, if you have a claim and they say, well, I don't know, those costs and expenses you said you had or whatever weren't real, blah, 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 give us the records. So you can see in the process of doing a claim and indemnity, if they give a leeway for these guys to demand records, it could get really onerous, particularly with a highly complicated farm, if they can push all the way back to, justifying your tax records, and then they'll deduct all these things. And we've seen farmers who've been basically, in my opinion, screwed by the kind of system and weren't made aware of these things. And there was a class action suit in Wisconsin over whole farm revenue because the agent didn't explain these details carefully to the client, and actually the farmers won, so that was a good deal. But it gets hairy really quickly. I know Mark's a lawyer, so he's probably always interested in this, but yeah, there are a lot of insurance fraud, crop insurance costs, frames. There are a lot of cases. I actually read 4 or 5 whole farm revenue cases. Part of it is because they make it so unnecessarily, in my opinion, complicated. But that's our legal system, I guess. And this determining expected price is again, the insurance agent wants to know that you can really, a classic example is this: if you direct market a watermelon or you have a U-pick thing, you get a higher value usually for your product than you can in a wholesale market. So what do you want to insure it at? You don't want to insure it at the wholesale market, you want to insure it at the U-pick price. And if you know the records to show that you can actually get a higher price for your product because it's U-pick or it's direct marketed, then the agent, they well, we're not going to insure for that. You can't possibly get that much for a watermelon, And I can because, direct customer U-pick. And without verifying, they're going to try to push you back down to the lower level of coverage. And so when it really comes down to it, if you're not happy with your basically revenue guarantee, don't buy it. I mean, it's not worth it. And if you have to go through all this malarkey to try to figure out, to prove to them that you can actually get this value, you can see that there's a little bit of negotiation on both sides of this. Also determine expected yields. Again, supported by what if you're growing a new crop you have no history of growing? Well, then you have to get some records from somewhere, from land grants, from other places to show, yes, it's doable to get this yield. They're usually based on historic yields, RMA and other sources for details. You can buy this policy here in Montana by the 15th of March. So there is still time to buy if you're interested. Bottom line, whole farm is improvement, I think. It will lower the overall public cost. If we eliminated all individual policies and only allowed whole farm revenue to be the cost to taxpayers, I would bet, I haven't the research to prove it, but I would bet the public cost of crop insurance would lower significantly. It does incentivize diversity, which I think is connected to sustainability, That is why I've always been involved in this policy, is that I believe by having individual policies that are so good, people have to keep growing corn because corn is in part, if corn is insured so well. It's even insured in Montana where we may not even particularly grow it. So does that great insurance, revenue-based insurance for a particular commodity induce farmers to continue to grow 1 or 2, 3 crops? I would say yes. There's still research to be done on that, but this is a kind of insurance that produces, that incentivizes diversity, and therefore incentivizes sustainability, in my opinion. Sometimes whole farm is the only thing that's available for the kind of thing. And you want to grow lavender in Montana, whole farm, you can do it. No other one you can't.
Jeff, do you have the stats on how many people are turning to whole farm revenue?
Unfortunately, not very many. I think there were like 2,000 some plus policies. It's hovered around 2 to 2,500 to 2,000 over the last few years. It's not growing. It's not declining rapidly. It's pretty much staying stable. All of the issues that came with it, I think of it. I actually honestly think over the years, if they would take our recommendations, that would be one thing. So if they would reform the way and I don't have time to go into all the reforms, but basically the reform is just to make it simpler, easier, and more straightforward to access. If the insurance companies that are the AIPs, the ones that the 13 companies, there's one company that's kind of interested in selling whole farm, but the other ones would rather see it go away. And they have a lot of political power. Who gets to call the shots? The insurance industry, the crop insurance industry, or us farmers collectively working together? I would say the other ones have a little more political clout than we do. But we've made progress. So if it was reformed, improved, I think we could get more usage. People knew about it, more it would be usage. It does have a niche. I don't think that if you're really highly diversified, multiple different market farmer, that it necessarily is the answer for you. But if you are growing in Montana, if you're growing some very esoteric emmers and different kinds of products that are uninsurable any other way, it is an option. And I think it should be an option that is considered more. And if the agents would help people understand and run the scenarios and run these products for them, they could investigate it. I'm not saying it's, it's perfect, but and it certainly needs reform, but it is an option, and it's unfortunately not an option being promoted very well still to this day. And it's kind of a negotiation, and it's not private insurance. So again, you really should be able to go to an agent and say, I want to investigate whole farm revenue, run the scenarios for me, tell me if it works for me or not. What really happens is they go in kind of meekly and say, I heard about this whole farm revenue, and the agent will immediately say something like, oh, you wouldn't possibly want to do that. And they are saying that because they don't want to spend the time to do their work. And I shouldn't say that. It's true of all of them. Some are helpful, and find one that is going to be helpful. And if they're not going to be, you hate to go to an agent and say, I demand my rights for you to run these scenarios for you. You don't want to work with an agent who doesn't want to, who says, okay, well, I have to, I'll do it for you. That's not a good situation. You've got to find one who's at least interested in running the scenarios for you and exploring the possibility of it, letting you know the limitations and advantages. And we have tons of information on our website. Over the last 16 years, I've generated too much. And we also have a wonderful short courses, webinars, and podcasts on these.
And they can always come to you too, right, Jeff?
Yeah, right. And I could be the insurance agent for the entire freaking country for all farm revenue, which I have done. I have done many. I have helped many an individual through the basic processes. And unfortunately, I will help them. Then they'll go to their local agent, and the agent will spin stories and drive them away from it, which is unfortunate. We did a survey of crop insurance agents as part of related to this in organic insurance. And the responses from the agents about whole farm was everything was, this is a piece of SHIT, to this is the best thing, you know, the most creative new policy ever.
Hmm.
And so there's a very wide, but I would say on preponderance is that most people that sell, most crop insurance sell a few products. The way you make money as a crop insurance agent is to renew, renew, renew. You get a client base of farmers you serve who have, you know, 3 or 4 different crops. You basically renew those policies over and over again. Renewal is a very simple process. Once you go through the first process, you maintain your clientele, and you don't want to deviate from
Okay.
that.
Mark has a question. His
Yeah.
hand is raised.
Thanks, Jamie. No, I like what Jeff was just saying. I wrote my question down before we started into the motivations of the crop insurer definitely are going to affect negotiations and also the choice of the insurer. The reason I brought up the whole record keeping thing was, you know, that was a struggle for me early on. And I think for other people who really don't like to keep records in the first place.
Right.
And so, you know, this is something that I think anybody who has gone beyond the backyard level of production is going to have to confront, and maybe it can be worked into sample spreadsheets that MOA or somebody else can provide. I wasn't looking at insurance fraud. I was looking more at, although that's an issue, of course, but I was looking more at how do you prepare yourself to walk into the crop insurance agent's office and make a good presentation without coming off like a total hayseed and not, you know, having no clue as to either what's going on, what you're asking for, or what you're really even trying to ensure.
Mhm. You know, the fundamental difference with, you know, the individual policies, that's relatively easy, and everybody has been using them for years, and they're, you know, their actual production history records. It's just pre-forma for those. Those are very simple policies, and there's still fraud in those. I mean, any insurance, there's an element, there's always been fraud. Actually, the RMA does a very good spot checking system. I've even read research showing that there is fraud, but there isn't a tremendous amount of fraud that people think there is. Sometimes I think the RMA is like a paranoid bureaucracy. I mean, they're really worried about fraud, but they do a really good job, and it's not that bad. You know, it's not bad as bad as some other areas. The problem with whole farm then is the fundamental thing is that most people trained in understanding this concept of ensuring the revenue potential generation of a farm is such a different perspective. You know, you could kind of jokingly say, well, wouldn't we all love, I mean, I'd love insurance for my income, you know, if I lose my job or I have variable income. You know, it's a pretty nice thing to be able to, here's the potential income generation of this farm. I want to insure a percentage of it. It's a whole different way of doing it. And because it's so different, it just drives all these agents with historical, unless you're, you know, we found that the very younger people who want to establish, than agents who want to establish new business, they're the more people interested in whole farm. And the record keeping, of course, is a problem, but, you know, I'll just use Doug Crabtree because he's out there. I mean, Doug grows a lot of different things. They're all grains and oil seeds and pulses and whatever, but he grows a lot of different things. His farm is kind of complicated. He takes whole farm revenue and he takes individual policies too. But, you know, he does the combined thing. And, but he does pretty good record keeping, even for a farm that, you know, you wouldn't think be all that onerous. But if you're a little guy with 50 different things and all these different outlets and maybe even some value added things that you add into there, tracking all of that for those guys, you know, to the level, unfortunately, that farm agents and this policy has been moving towards, has just made it onerous for that segment of the population, which in some sense it was intended to serve. But it just got worse. And again, we have very good ways to make this better, which I could speak at length at, but they don't listen to us, and there's a kind of, I hate conspiracy theories, but I have this feeling that most of the 13 companies don't want to provide this product anymore, and they're doing their best to see that it doesn't get used well by people. Now maybe that's total paranoia on my part, and maybe it's just spending too many years studying it. But I really, there's all this thing. So maybe it never is going to work for the highly diverse farm, but maybe for the farm with 10 different products, this could really be something useful and support sustainability. And yes, I think we need to improve record keeping across the board. We do a lot of work on trying to develop models and ways to make record keeping easier. And organic systems plan almost does it for you. A good organic system plan will be very helpful in taking the whole farm.
Craig has a question. Is leasing land something that can be included in revenue?
No, that's not. That's not a revenue generated by production of the crop. So your income from your lease, I'm not sure exactly what the question is, but it's, even individual policies, it's based on the revenue of, the price, your historic yield, expected price from the crop you're insuring. Really leasing. Anyway, from a whole farm perspective, it's only the revenue generated from the production of the products the farm produces, not off-farm income or other income. It's not protecting that part of your income.
So what happens with crop share?
Well, the farmer, I'm not quite sure, but what you're getting at, but I assume that the person leasing the land is going to insure to their extent. So if there's an indemnity, I suppose they share in the indemnity as well as I don't think in the lease you share costs. So the cost of insurance is usually borne by the person leasing, not the leaseor. I'm not quite, maybe I'm missing the point.
That's Mark's question. Mark, does that answer it, or did you want to dig into that deeper?
I mean, it gets complicated. There's different kinds of leases. I don't know. Doug was talking about where some people that are he's leasing land from will share in actual costs. So in other words, they'll pay part of the burden of insuring the crop. I'm certainly that if a crop fails, and you owe a certain amount on your lease, that's just what you do. And then the insurance payment will then help you still pay your lease. But I don't think a lot of people that are leasing the land want to get involved in the details of the operation of the business, even on their land. But I'm not an expert on leasing arrangements.
Yeah, I think it's just bringing in a lot of complications. If you don't have a clear, quick answer, it's something would probably be situational, and the agent would have to figure that out with you.
Yeah, I mean, when you take a lease out of, maybe other farmers here, when you lease land, does the person leasing the land say, and thou will take out crop insurance? Can they have that degree of control over the farmer that they're using the land? I don't know. Or that's the determination of the farmer whether they want to take the risk, but they still owe the lease. So if they take the risk and they lose, then they got to come up with the money to pay for the lease. Or maybe it's in the share, whatever. I don't know.
Okay, anyone else? Well, thanks, Jeff. Oh, thanks, Jeff, very much for your time. And Jeff will be has a presentation this afternoon at 4 about accessing federal working lands programs that also help establish your farm and and minimize costs, if not maximizing revenue. So hope to see you then. Have a good afternoon.
Thank
Thanks,
you.
Jeff.